the pension committee to order. And at this time, I would like to turn the meeting over to Alesco Advisors.
Tim and Jim, you're on.
Great. Good morning, everyone. It's nice to see all of you on this beautiful summer day here in upstate New York. Thanks for giving us the opportunity to report on the performance of the pension plan over the past quarter. I'll just start with a couple of comments. I'll go through the asset allocation and performance, and Jim will follow up with some information concerning the capital markets review and a little bit about the portfolio positioning. Before I jump into the numbers, I think I'm able to share my screen here. I'll make sure I do that first. Can everybody see the slide okay, for those who don't have a copy in front of them? So just as a quick overview of the capital markets in the second quarter, it was a very strong period for the equity market, as very solid economic data was a catalyst for the stock market. So that was certainly a positive in the quarter. You'll see in the numbers in the performance a slight shift in the leadership in the capital markets from the last couple of quarters. Large cap stocks outpaced both small cap and international by a little bit in the quarter as bond yields dropped. And we'll have some more information about that. But clearly the capital markets over the next couple of quarters will be grappling with the issues surrounding economic growth, how strong that is in the second half of the year, combined with inflation and the Federal Reserve's response to that. Those are the main issues we'll be dealing with in the capital markets over the next couple of quarters and how the market responds to that. Reviewing the asset allocation of the non-salaried plan, equity is at 66%. That's just a little bit above the midpoint of the range. Cash is at 1.6%, fixed income at 25.4%, and the real return inflation hedging piece of the asset allocation at 7%. Those are comprised of inflation-protected securities. Equity allocation has been consistent throughout the most part of our relationship with Centro, except for the period at the very beginning where we did increase the equity allocation of the overall plans. But as of the end of the quarter, large cap stocks were at just over 50%. The rest of the asset allocation spread down the capitalization spectrum over large value, mid cap, small cap, micro cap, and about a little over 29% in international. So very well diversified portfolio covering a lot of the different asset classes, and that's a benefit when you have the shifting performance like we saw this past quarter. Fixed income, we continue to hold a slightly shortened duration to the overall bond market, and that's accomplished with that slice of about 10% in corporate investment grade floating rate bonds. The duration of the overall portfolio for fixed income at 6.7 years, 6 years versus about 6.7 for the broad bond market. So taking on a little bit less risk here, and for the inception period, that in the quarter, that's been a little bit helpful in terms of performance. At least over the past year, that's been helpful from a performance standpoint, holding that short duration. We'll see that in the performance. Taking a look at some of the performance periods that we have available here for the non-salaried plan, the quarter, year to date, going back to the beginning of the year, your 1 year period from 6/30 to 6/30, and then the inception date, which is January of 2020. You can see the quarter was a very strong period, 5% return, almost $1.9 million in gains, and the value of the plan at the end of the quarter was $39.8 million. Year-to-date returns have continued to be positive, $3.4 million gain, a return of 9.5%. The 1 year return, which reflects a good portion of the recovery from the pandemic lows in the spring of 2020, the return is 27.2%, $8.4 million gain. And since the beginning of our relationship with Centro, a return of 17%, and that is an annualized return at $8.2 million. Looking at the performance of the underlying asset class, this will give you some information about how that shift in leadership occurred in the quarter. You can see that the equity return was 6.59% overall, large cap stocks at 8.5%. That is different than we've seen really since the beginning of our relationship, as the economy and the stock market have rebounded coming out of the pandemic lows. small cap up 4.5%. However, on the year-to-date and back to inception returns, equity markets have had a great year-to-date, 15.28%, very strong returns from the overall equities in the portfolio. Large cap stocks up 15.25%, but you can see that the asset class leadership this year has been in the other asset classes, small cap, at least domestically, small cap, mid cap, and even value stocks outperforming. So having a broadly diversified portfolio has been, asset allocation has been very beneficial so far this year, year to date. And then the 1 year numbers, again, as I said, coming out of the pandemic lows, 43.59% for equity returns, and small cap and mid cap leading the way there. But interestingly, emerging markets over the past year has had a slightly higher return than the S&P 500, 40.9% versus just about 40.8%. So that's an interesting dynamic we'll be watching over the next couple of quarters to see if we can continue to have some better performance out of the international markets than we have had over the last couple of years. And then just very quickly, the inception return at 19.69% for equities. And during that period, the small cap stocks have been the best performing asset class at 23.7%. Large cap, not very far behind there at 23.13%. Fixed income returns in the quarter, reflecting that drop in bond yields, a return of 1.87%, just about in line with the Barclays aggregate. In the year-to-date period, though, we do reflect the big increase that we had in yields at the beginning of the year, and the shortened duration on the fixed income holdings benefited, a negative return of 1.48 for fixed income compared to 1.6% for the Barclays aggregate. And then when you look out over the inception and the 1 year period, very close to the Barclays aggregate in terms of the return for fixed income. Again, one last point about the diversification in the pension plan from the asset class holdings. Real return assets continue to outperform the broad bond market. And real return assets are comprised of inflation-protected securities, where the principal and interest is adjusted based on the CPI. And as we've had both a expectation of higher inflation and then actually realized, the inflation-protected securities have done quite well, up 2% in the quarter, 2.6% in the quarter, 2% year to date. And then well ahead of CPI over the last, since the inception, 9.5%. So it's been a great diversifier in terms of performance for the overall pension plan. Any quick questions?
Yeah, I was just going to say the same thing. A lot of information there. Are there any questions?
What is the current return on the TIPS? Meaning the interest income the portfolio is getting from it.
Yeah, I couldn't give you the exact number. I'll give you my guess is that it's about 1.25% yield. It's a blended average. We're in a couple of TIPS investment funds, but we can get you an exact number.
Yeah, we'll get you that exact number that we don't have off the top of our heads.
Yeah, what happens with TIPS, as Tim had pointed out, is that the price of the bond increases lockstep with the consumer price index. And so, if, as an example, the year-over-year increase in the inflation number that was just announced is 5.4%. So the TIPS security that had a comparable, it had a market level, we'll say, of duration, would have had a pricing increase of roughly 5.4% as well. And then in addition, you get the yield, income yield. So, but we can get you the exact yield on the TIPS holdings. Again, it's going to be a blended average.
Thank you.
I'll scroll through the next couple pages. These are the holdings in the non-salary plan. Moving on, just for interest of time, taking a look at the salary DB plan. I'll go through this very quickly because all three of the pension plans are allocated in a similar fashion. and their returns are all very similar. So you can see the equity allocation for the salary DB plan at 65.9%, and the rest all allocated in a similar fashion as the non-salary plan. Equity allocation, similar fashion, about half the holdings in large cap stocks, and then the rest spread, the large cap domestic, and the rest spread down the capitalization spectrum and into international. Shortened duration again in the fixed income holdings for the salary plan. Performance, again, similar, 5% in the quarter, 9.5% year to date, 27% over the 1 year, and 17% as of the end of the quarter, or as of inception, as of the end of the quarter. Value of the plan, $38.567 million at the end of the period. Similar story here on the asset class performance, equities, fixed income, and real returns, all the similar patterns. Holdings, again here on page 13, 14. Then for the Utica plan, finally, asset allocation, very similar to the other two plans at 65.9%. A little bit more cash in this plan at 2.6%, fixed income at 24.8%, and the inflation protected securities at 6.7%. Equities, same allocation, fixed income, shortened duration as well. Performance for the Utica plan, identical as well, 5% in the quarter. Value at the end of the period, $11 million, a gain of $519,000. 9.5% year to date, 27 at 16.8, back to inception at the beginning of 2020. $2.2 million gain during that period. Same performance of the asset classes here as well. Page 20, 21 for the holdings. With that, any questions at all about allocation or performance?
Can we,
If not, I will hand it off to Jim.
Oh, got a question.
can we go back to the current return? Can we talk about, what's the current return of the fixed income portfolio, that portion of the portfolio, the bond portion?
So,
Yeah.
So you're looking for the fixed income performance.
Not the performance, that would include the capital gain on the, when the interest rates come down. I'm looking for, what is the bond portfolio yielding on a current return basis? I asked that question about the tips,
Yeah.
now, you know,
Yeah.
what,
Yeah, the bond yield is approximately 1.4% right now.
Right.
Very low. So we can talk more about that from a broader economic perspective, but that's the environment we're in right now. It's our belief, as you can see how the portfolio is positioned, is that this is not a good time to be chasing yield really, and taking on a lot of credit risk. The spreads in non-treasury investments, so your corporate, even investment grade corporates are very, very tight. And even high yield, the spreads are below 300 basis points, which is an extraordinarily tight spread. So we've been in a yield-starved market for quite some time, and I think that a lot of the investment world has been lulled into a more complacent perspective as it relates to credit risk. All it takes is a little bit of a hiccup in our economy, and those types of assets have tremendous downside risk. And so, you know, just a little bit about our philosophy, which we have talked about before, is we generally, if we're going to take risk, we're going to do that in the equity part of your portfolio. The bond part of your portfolio, we're going to be very risk averse. That doesn't mean that we wouldn't from time to time move away from exclusively investment grade holdings. We've done that in the past, and we'll do that again, I'm sure, in the future. But when we make that move, we want to make sure that you're getting paid for the risk that's being taken. We want to have higher spreads, and that's just not the case right now. So, you know, as we go through this economic cycle, assuming things continue to improve, which we think is very likely, and we think that on a delayed basis, we're going to see economic improvements outside of the United States. It's very likely that we're going to see higher levels of inflation, more of what we've already seen. And so at that point in time, we would expect spreads to widen out, and that would potentially make holding non-investment grade bonds look more attractive, and we would, depending on what the specifics look like, we'd be considering using those bonds in your portfolios.
Thank you.
Sure. Tim, why don't we go to the next slide, 23, please. We're on page 23, and I just want to do a time check here. It's 9:23. How are we set for time?
We got about 7 to 10 minutes. Thank you.
So I'll give you the Cliff Notes version of these different slides and try to hit the high points. As you're all aware, the U.S. economy has really been rebounding in a very material fashion. The two charts on this indicate that both the service sector, which includes the beaten down leisure and travel and hospitality sectors, and manufacturing, both services and manufacturing have not only recovered, but what the top chart indicates, it's survey data that suggests that people who run these businesses in both service sector and the manufacturing sector are confident that things are going to continue to be good going forward. Putting one's money where one's mouth is, you can see capital goods orders on the bottom chart very much reflects that thinking. And this is important for a couple of reasons. One, as you know, we're in a tight labor market. People are not coming back to work as quickly as one might have expected. But businesses, the businesses that we were just discussing, particularly manufacturing, as well as some service sectors as well, are spending a lot of money on capital goods. And that means that they can get more work. There's more productivity per unit of labor that is used in these different businesses, higher levels of productivity, and that's what's going to be needed in order to deliver the services and products that are in demand right now. But it also is good for the worker, because the more productive the worker is, the more the employer can pay that person. So these are two very positive signs as it relates to future economic activity. I won't talk too much about jobs because it's something I'm sure you've all been reading about. The bottom chart is probably the more interesting thing. We look at the job openings, that number that we're seeing. There's actually more job openings now than there are people who are officially unemployed. In other words, people who are in the workforce and are not working right now. So that also is very positive for future economic activity as people come back into the workforce and take on jobs. Though a paycheck is far more likely to be spent more quickly than a transfer payment. Transfer payments, about a third of the transfer payments that have happened with the different stimulus packages have gone to either pay down debt or have gone right into savings. And so paycheck income is different. It's recurring. People know that they're going to be getting it on a going forward basis, and they're more likely to spend it. Next slide, please, Tim. On page 25. Sure.
This is Nick Lano. I just want to make a comment to we have some really great new board members here. I just want to just throw a number out there. We're talking about managing pension money here, retirement money of, I don't know if you saw all the numbers, but it's about $90 million. I just wanted the new board members to understand that it's a fairly significant amount of money that we entrust in Alesco here.
It's a defined benefit plan that we closed back in 2011. So any new employee coming in is a defined contribution plan. Okay. Appreciate that.
Yeah. I just wanted to make that point because it is a significant number.
Yeah.
Yeah. Okay.
Yeah, it is. Yeah, and I can assure you, at our end, we take the role very seriously and pay close attention to all the movements in the market, but also very close attention to how the portfolio is positioned relative to your risk profile as defined in your investment policy. Tim, if you could go to page 25, this is just, these two charts here really give you a little bit of insight in terms of what the consumer's mindset is. Very positive. U.S. People, you, me, our neighbors, our friends, we're not afraid to spend money when we have it. And but there are periods of time when the pandemic hit, as an example, where people sat on their wallets. Some of it they didn't have any choice, and some of it was by just out of fear, wanting to conserve capital. So now you see on page 25 that has reversed, and people are out, they're back, they're spending, and the top chart there, the TSA traveler data and the seated dining is a good insight in terms of the market psychology, consumer psychology. People are feeling comfortable enough to go out in public and have a little fun again. Next slide, please. Same thing with housing. We all know, you're all familiar with housing prices. We've got a combination of a tremendous amount of demand and relatively small supply. Housing prices have popped really across the country, very few exceptions. And coincident with that is demand for new homes. When there's not much in the way of supply of existing homes, people try to build a new house, and home builder sentiment is very high, but they're struggling with many of the bottlenecks that you've been hearing about, both as it relates to labor as well as raw materials, and that has slowed things down a little bit. So that's an area where we think you might see some softening in the relatively near future. The levels of appreciation are certainly not likely to continue, and we may even see some price declines, particularly in the more traditional, weaker markets. Next. Inflation, Tim kicked it off with talking about inflation. We saw the CPI data was at 5.4% for June. The PCE data, which is the personal consumption expenditure inflation data, which is has less of a residential costs, housing have a less of a weighting in the PCE data. The personal consumption expenditure data is what the Federal Reserve looks at. But in both cases, what you can see is we have seen a significant increase. We're pointing out, you may have seen the little tidbit about used cars. Used cars are, kind of crazily priced right now. There are stories of people who bought used cars 2 or 3 years ago, have been driving around for the last couple of years, and now they can actually sell them for more than they paid for them a couple of years ago. So there's some shortfalls in supply for some key products and services, and so that's where we're seeing the real price squeeze. Next slide. So where's inflation going? The honest answer is nobody knows. It's something that's talked about a lot, but there's estimates are all over the board. What the bond market's showing at the top chart here is there's a calculation that's used to what the bond market is pricing, where the bond market's pricing inflation to be. And what you see here, the way to read this chart is the x-axis, which says tenor, or years to maturity. At the 1 year data, 1 year out, you can see inflation is projected to be about 3.25%. And then it drops as we go farther out over the next 10 years. The key takeaway from here, from our perspective, isn't so much where the orange line is, but where the orange line is relative to the blue line, because the blue line is what the bond market was thinking just 6 months earlier, and you can see how much different it is after just a couple of quarters. We could be looking at an orange line that's considerably higher than what the current one is 6 months from now. So this is a big dynamic, and it's going to have a profound influence in the pricing of, first and foremost, fixed income securities, because if we do have considerably higher levels of inflation, we want your bonds and your pension plans to be positioned where they currently are with less interest rate risk. And also, we think that in the near term, at least, it's very likely that equities will do quite well. We'll talk more about that in a minute. But the bottom chart reflects that in rising inflationary environments, what parts of the capital markets perform best. And you can see value stocks and small cap stocks are the best place to be. And your portfolio is skewed in that direction. Not overwhelmingly so, but there's a skewing, a tilt in towards value into smaller capitalization stocks. So we think we've got you in pretty good shape on a going forward basis. But again, we're very attentive to all of this. Next slide, please, Tim. This is just the green box tells it all, the lower right-hand part of the slide. After 30 years, what happens to a portfolio that's diversified between equities and bonds? That 65-35 portfolio column reflects a 65% equity, 35% bond allocation. And the bottom line, where it says real value, if you're looking at the green box in that column, real value line, you should be looking at a number that says $3,745,000. That's what the value of $1 million today would be after 30 years. So you can see there's some real purchasing power enhancement. If you just own bonds, you're looking at a number that's about a third as high. And if you just put the money under the mattress or put it in the bank in cash, that you actually are losing purchasing power. And this, given the impact that inflation has in eroding the purchasing power, we're assuming an inflation rate of 2.5% here, by the way. Next slide, please, Tim. I'm going to skip the Federal Reserve discussion. We talked a lot about that in the last quarter. I'll skip this slide, Tim, just because we're behind schedule. Let's go to page 33. This is really the key takeaway, I think, for the last comments for today, unless you have questions. Purely from an equity pricing perspective, let me be very clear about that. We're not at all talking about the human pain and suffering associated with the pandemic. But because of the pandemic, there's this deferred opening, a deferred recovery in non-U.S. economies. And you'll see that at the top chart there, where we're looking at GDP growth, and we look at the first quarter for Europe, Japan, and the UK is negative. Those are the blue bars. And on the far right-hand side, you can see in the United States it's positive, considerably positive. So that's why our stock market has done so well. Now, you look at the gray bars, and we look at what the projection is for 2022 in terms of GDP growth. And you can see that Europe, Japan, and the UK are looking at significant recoveries. And the United States is also going to be growing, but not at the same pace we have as of late. So what's the takeaway on that? What does all that mean? Well, there's two things. First of all, we're dealing with a tremendous number of bottlenecks in terms of supply in our economy right now, and that's a large part of the inflationary pressures that we're feeling. A lot of press has been looking at the semiconductor shortfall and the impact that has on a variety of different products. That's one example. There's a bunch of others, as you know. So you can imagine how much worse it would be if all of these other economies were recovering at the same pace as the United States. They're not. So there's a silver lining to that as it relates to the U.S. economy. As these bottlenecks get addressed, that should allow these foreign economies to recover, as well as hopefully the higher levels of vaccination and the economy's opening up. And that will lead to a more robust 2022, and that should be good for corporate earnings. Investors like to see steady level of earnings, and if we can see the U.S. economy continue to grow, non-U.S. economies beginning to recover, that's probably going to bode well for equity pricing. That's not at all, don't read that into saying that we're going to see the next 12 months look like the last 12 months. That's very, very unlikely, but it could be very attractive inflation-adjusted returns for equities over the next year to 2 years. And that's it from our perspective. Any questions?
Any questions for Tim and Jim?
I don't have a question, but I just had to smile when you said put the money under the mattress and stuff like that. My grandmother used to take money and put it in can
Can.
in the ground, you know.
Yeah, I was the can guy too. An old accountant told me one day, as long as you're saving, I don't care if you put money in a can, you put it away, you're doing well. But I wanna thank Alesco for your, very involved presentation. You guys have been good partners. I wanna thank you. And, we're gonna take a couple minute recess, okay, before we go into audit and finance.